Stock analysis relies on two primary approaches, fundamental and technical analysis. Fundamental analysis evaluates a company's financial health through income statements, balance sheets, and cash flow reports. Key metrics like price-to-earnings ratio, return on equity, and debt-to-equity ratio help assess profitability and risk. Investors also examine management quality, industry trends, and economic factors like interest rates and inflation. Technical analysis focuses on price patterns and market trends. Chart patterns, such as head and shoulders or double tops, signal potential movements, while momentum indicators like relative strength or MACD, looking at moving average crossings, can help identify entry and exit points. Trading volume and investor sentiment provide further insight into market direction. A balanced strategy may combine both approaches. Evaluating financial fundamentals alongside price trends helps investors make informed decisions, reducing risk while maximizing long-term returns in the stock market.
Mariko, I know that as an analyst, you're great at finding undervalued companies that have some positive catalyst happening. If you can take your CFA hat off for a moment and then you put on your CFP hat, do those metrics that were important to you before, do they matter to your clients today? Because the objectives and outcomes that they care about, I think, are very different.
Yeah, it's been an interesting journey because I used to be, concentrated portfolio, small caps, bottom-up stock picker, held positions for, as long as 10 years, right? And I got to know our companies really, really well. And that was part of the understanding of the business ecosystem that we're in. And then you marry that with valuation, what's going on in the larger market. So an opportunity to see where things are understood. And it's interesting for me personally too, right? Where I've got a portfolio that's well diversified, low cost ETFs. And then I have another that's still like leftover Daruma positions and the odd sort of, stock picking thing. And there is something to be said for the psychic peace that comes, the psychological peace of mind that comes from, I just have a well diversified, well asset allocated portfolio that's in keeping, in alignment with, my investment objectives and everything else. The stock picking is much harder to do, in a non-institutional context. And the opportunities are where there's like dislocation and a lot of emotionality, but it's much less about really understanding individual names. And I find that my clients, right, want to understand the market and they want to understand what's going on in their money, with their money. And so they want to learn about that. But they're really less interested. It's the conversations are much more about what's going on and what's moving than it is about the individual, the return on invested capital or the asset allocation decisions that are being made in the specific stocks. I'm sorry, this is a long way around Robin Hood's barn. All I can say is I have come to appreciate in my second career, right, the joys of having a well-diversified, well-balanced, portfolio of ETFs in a way that I, as a stock picker, as a professional institutional investor, would have been, oh my God, that's so boring. I'm like, yeah, that's kind of the point, particularly now where like a lot of the market structures. I think it's really hard, if not impossible, for individual investors to do the kind of analytical work unless they know something about about an industry and they're willing to use market opportunities and are willing to hold things for a long time. I really feel like there's so much information and so much noise that you'd be chasing so many rabbit holes that your quality of life is just gonna suck if you're not professionally stock picking in certain niches. I think as an amateur, I think it's really hard. It can be interesting. Do it for 10% of your portfolio and learn from your mistakes and have it be as a awareness, growth opportunity for, your understanding, your deeper psychology, put most of your money elsewhere. Anyway.
David, is that good advice for the non-professional investor? Do you earmark 10% of your portfolio? And I'm curious, how do you simplify complex financial analyses for individuals to help them make informed decisions?
Well, I agree. Michael mentioned the 54% success rate for hedge funds, that make millions of dollars a year. I mean, individuals, the idea that they could replicate that, especially when you bring on the emotions, just doesn't work. But what investors can do, individual investors can do, institutional investors can do, is look at the underlying drivers. So most asset classes, it's driven by the cash flow growth, and what investors are paying for that cash flow growth. And so what we've done at Asset Camp, and I've taught in the past decade, is look at that, understand, the 46 stock markets around the world, growth values, small cap, large cap. What is the cash flow? What's the dividend yield? What is the expected earnings growth, the historical earnings growth, and what are investors paying for that? And to rank those and look at them from, based on standard deviation, what is the cheapest and what appears to be outlier, and use that as guidance for rebalancing to, for example, move out of large cap growth in December into World ex US small cap value. I mean, the numbers showed that large cap growth had, of course, those companies are growing, but with a PEs of over 40 collectively, 2 standard deviation more expensive than average, it didn't make sense to continue that overweight that had that.
Hey, Mike T, how do you balance fundamental and technical analysis in what you do? And what risks and opportunities do you see right now?
Well, how you value it, how you should value it, largely based on free cash flows and all those other good things, but how it is actually valued is much more important to understand. And it is not what I think, it is what everyone else thinks. And that's what moves markets. So in my experience talking to investors, and it's been really eye-opening because you may not know, I have essentially had 2 clients for my entire career, Ken Griffin and Izzy at Millennium. And that's it. And my conversations with them over my entire tenure of running hedge fund money, which is, 15 years or so, or 20 or whatever, I think would all fit on one piece of paper folded in half. And that would be it. So I never talked to clients until I started running Pink and building this. And now I have the privilege of talking to hundreds, if not more, of money managers that are out there. And the one prominent feature to their entire stock picking prowess is charts. And that's it. And that's all they use is chart trends. And so I actually think the entire world, essentially, including the CTAs and passive flows, have adulterated stock picking to the nth degree. So I actually think it is simply momentum charts that run everything. And when you step off that momentum wagon, you better have a really good reason for it. And I think that's how every book is set up, in fact. Or let's say 98% of them. And everyone else simply underperforms, or at least has done for the past decade.
Chris, what are your thoughts? I mean, we're in this world where ETFs are so huge in fund flows. You feel like if you're an individual stock picker, the tail is wagging the dog, right? Because you're trying to make some decisions on individual companies. You've done the research, you find earnings are accelerating, low debt on the balance sheet, things look great. But at the end of the day, is the S&P 500 getting inflows or outflows?
Yeah, I agree. It's tough because just so much of the market is now controlled by quants and quant flows. And I mean, it's proven that the S&P, it's just a tough index to beat because the S&P has survivor bias. I mean, they keep on kicking out the worst performers, and they keep on adding new companies that have grown into something, and that tends to be more good companies. So over time, the S&P has been, I think, a great index to own. And I think Warren Buffett had that bet for many years that the S&P would beat hedge fund returns, and I think he would. I'm pretty sure he won that bet over time. So I think definitely for the individual investor, you just park it in the S&P and don't worry about it. A lot of the time, it's you don't have to worry through earnings season and a potential blow up of an individual name just because they pull their guidance or guide even a little bit light nowadays.
Well, here's the question. I mean, what Mike was talking about is that it's more important to make money than to be right. And also, you try to do your valuation work, but at the end of the day, it's ultimately up to Mr. Market. Like, Mr. Market's going to tell you what the answer is. So in this world where there's so much uncertainty around inflation, rate expectations, trade wars, to what extent do we try to anticipate and position our portfolio versus just watching Mr. Market and following a trend? Chris,
Right,
maybe you first, and I'll just go around. Everybody can chime in.
I would say just investing in the S&P and never touching it, I think it's a great theory, but one that not too many people can actually execute, especially in times of distress. People aren't tied to the S&P. Then they're just going to be like, oh, I'll just trim it back or I'll sell it out just so I can sleep at night. And I think the positive with individual securities, perhaps over an S&P 500 in times of distress, at least you can say, oh, I own this company because I know that I'm comfortable with the cash flows growing over time, and I can put a value on that, and I will stick with that. Even if the world seems like it's falling apart, I feel comfortable in owning this company for the next 5-10 years. So I'm not going to kick that out, but maybe because I don't have an emotional tie to the S&P where I can just pump that out just so I could sleep at night.
Mike, how do you anticipate versus trend following?
That's actually an incredibly good question. And that's why I'm tied to my desk for 12 hours a day. And this is why if you're not willing to do that, you really shouldn't be trading individual stocks yourself for the most part. So how do I do it? I read a lot and I think about the setup, and I look at, and when I say the setup is who is where and why, and what is going to change next. Like for instance, before we went on camera here, we were talking about the budget coming up, and people don't put much thought into it, but I think there's a high probability this is going to be a budget busting budget, and we're going to be running well north of $2 trillion deficits for the next year. And where kinetically is that money going to come from to pay for that? And 40% of the treasury buying happens, it's more than that, but let's just say 40 is OUS, outside the US buyers. And they're going to have fewer dollars moving forward because these tariffs are going to be here to stay, to buy much more treasury debt than anticipated. And bonds tend to move on issuance and the supply and demand features, especially for sovereign bonds like the US Treasury. So what's going to happen there? I think that we're going to have really difficult treasury auctions moving forward once this budget goes through. And it might happen a little bit before that. So what I'm saying is you have something that nobody's really paying attention to. And when are new kinetics going to take effect? And I spend a lot of time on that specifically. When and how will they be manifest? And I was starting to put on bets around that right now for those future auctions and what does gold do and so forth. And so I'm anticipating an event that is going to change the kinetics of flow. And so that's what I spend time on thinking about for these more macro moves. is exactly that change in money flows and what happens to those kinetics. Like for instance, Vietnam. And I'm looking at the chart right now. Vietnam just lifted. Their stock market is breaking out, and it just went up 15% in a month. And nobody really understands why. I think maybe this panel may not understand. We have this tariff problem. What is going on with Vietnam? Why is the stock market all of a sudden moving? Well, it's because China stinks so bad. And you've seen a unbelievably abrupt departure from manufacturers in China instantly buying up assets and setting up shop in Vietnam. And so wage growth, I think, in Vietnam is going to go up an awful lot. They're going to have inflation and actually really, really good GDP comps because the entire world is trying to get the heck out of China and move to Vietnam. And that's why. So I cite an event that's happening. I talk to a lot of these people that are moving their business specifically to Vietnam, and all of it in a month. I mean, it's astonishing how many billions and billions and billions of dollars are coming into this little country in order to get manufacturing going. And it's going to have a profound impact. So I have this sort of data point that it's soft. I can start to quantify it. And surprise, the stock's already started moving. And so I think Vietnam is going to be a gigantic beneficiary from essentially the decline of Chinese labor. How do you trade it? You go long Vietnam. I'm personally long Vietnam. But I'm watching it right now, and it's moved an awful lot more than I would have thought. But I suppose we're going to find out very soon what the numbers look like. So again, we have an event. I think about the kinetics of the flow, what it's going to do, and then translate into a stock or a trade. And hopefully I can get in front of that.
Kinetics and the flow. Thanks for the insight into how you anticipate. If David and Mariko don't mind me skipping and going into segment 3, unless you guys have something to chime in.
Okay.
Cool. Let's go to segment 3.